recession. It's all we talk about at the moment. Are you telling me it's still not well priced?
I think shallow recessions are priced in. So if you look at fixed income markets, you look at credit markets, shallow recessions are priced in the US, in Europe. So one question there is just, how big the slowdown will be. But our asset allocation experts, our equity analysts, think that equity markets aren't pricing in enough. So a bit of a gap between credit markets and equity markets. Obviously, often the same companies involved, and so a positive view on credit versus equities, given that disparity.
And do you see the opportunity in fixed income more broadly then, right now?
Yeah, no, I think it looks quite good in terms of the fixed income outlook when you look out over the next few years, just given the starting levels of yield. So we've seen repricing across global markets. You have central bank rates and expectations higher, 10-year rates higher. Broadly, it looks kind of broadly fair to us. We think that you've seen a lot of the repricing, and that means that when you look at core bond funds, you look at a US core bond fund or a global fund, 5.5% type yields, more when you are looking at credit. So as a medium-term view, that looks really attractive. In the short term, there's the uncertainty your reporters have been talking about. There's uncertainty about the economy, the Fed, central banks more broadly. So tactically, I think it's a difficult time. But looking out over the next few years, the outlooks for global bonds, US bonds, looks quite attractive here, and a lot better than it was looking 1 or 2 years ago.